Indian equity markets have remained highly volatile since the start of this year. Such volatility has already made many seasoned investors jittery about their investments. Now, in such a market scenario, how should a first time investor start their investing journey? What are the factors that they must keep in mind before they start their investments? To answer all of these questions, let's welcome on board Neil Parag Parikh, Chairman and CEO, PPFAS Mutual Fund. Neil, hi, good evening, and thank you so much for joining in. Today, we will talk about how first-time investors can enter the market given the kind of uncertainty. But let me just ask you this first. How do you read this uncertainty majorly triggered by global markets?
Yeah, so thank you, Kavita, for having me here. So first thing is that I think we've got a little spoilt in the last few years, because we've seen markets just go one way. Even during COVID, it corrected sharply, and then it was just one way going up. So a lot of investors came in the last 2-3 years. And today, whenever I meet some people, they think it's their right to get returns in the stock market or with investing. But actually, markets are supposed to be volatile. They are supposed to go up and down. So in fact, this is kind of a normal market. The only thing is that the expectations the expectations had gone up too much. So that normalization will come in hand. Again, I think uncertainty will continue. We've seen 1 year of flattish markets. You know what? I think it could continue for some more time, 6 months to a year too. So it'll definitely test investors' patience. But I also want to say that to see the good time, these are the times you got to invest in, keep your SIPs running, and stay the course, because equity is a long-term product. It's a 5-year plus product. So don't let 1 or 2 years of no return scare you, because there is returns to be made going forward.
Exactly, Neil. So there is the first lesson that if at all you're entering equity, your time horizon needs to be 5 years plus. But also, usually, what we've noticed, Neil, was whenever people are guiding or recommending anything to first-time investors, people usually recommend these investors to start with a passive approach or maybe like an index fund. But before all of this, Neil, we need to do our homework, as in like just you mentioned, one needs to have the time horizon of 5 years plus. You need to line up your goals. What factors one needs to identify in the current market scenario if one is just starting out their investment journey?
So I think, Kavita, one of the mistakes I saw recently was, and let me start with that first, and then we'll get deeper into it, is that a lot of people started investing by looking at just recent returns or past returns, shorter term past returns, last 3 months, 6 months, 1 year kind of return. Also, a lot of people buy on just tips, or they've heard some fund that their friend has bought, or somebody randomly recommending them, and they go and buy that without even thinking about it, about why are they investing in such a fund or anything. So one thing is that don't do that. First thing is don't do that. Don't work on tips or random hearsay, or even looking at past returns of funds and invest. I think one thing people need to realize is that investing is a plan and a procedure. It's a proper plan you need to make for yourself, depending on your short-term goals, medium-term loans, and long-term goals. So one thing is that you need to have a balance between safety, means your emergency fund. And I feel that emergency funds are very necessary today. I think COVID has taught us that having some money just put out, if for in any unforeseen situation, you can use that money. So first thing is to have some safety money. Then you got to decide your goals. Are they medium-term goals or the long-term goals? By long-term goals, I mean 5+ years. If your goals are 5+ years, then you please invest that in equity, I think. And anything less than 5 years should be in debt and other products. So, and even before that, I think one is that you need to sit down and get your asset allocation done. Your asset allocation will be done by looking at your risk profile. So this is actually quite a tedious process. So if you don't have the time or the effort to do it, go find a good financial advisor who will help you out with these things. Once asset allocation is done, then just stick to that. I don't think it's rocket science. People try to do too much after that. Once your asset allocation is set, you just stick to your asset allocation and let it continue. So for a first time investor, it's very necessary to make a plan, get an asset allocation in place, and also to know your risk profile.
Exactly. So all of these things now kept in mind, Neil, will the strategy differ for someone who is starting out at maybe 25, at 25, and someone who is doing the same thing when 40 years old?
Yeah, I think it will differ from person to person. Again, it depending on your personal set. So we call it personal finance, and we call it personal finance because it's very personal. So what a 25-year-old's goal would be compared to a 40-year-old's goal, or what their risk profile will also be different. So I think this will be have to cater individually to each person. I don't think there's a universal kind of a plan that goes for everyone. I think each person will need to figure that out by themselves.
So, talking about the risk profiling, how can one identify what kind of a risk profile they have? So, because one is identifying the risk in the investment instrument, and one thing is knowing what kind of risk appetite you have. In last 1 year, people who invested through SIP or who started investing through SIP might not have seen good amount of return in their portfolio. So, how can one actually alter their behavior, their understanding when it comes to equity markets, the risk involved in it, risk management, and their own risk profiling?
Yeah, so a couple of things here. I think one is to figure out your risk profile, or how much risk you can take. There are a lot of tools online available also, and also a financial advisor can sit down with you and figure out how much risk you can take. That's one part of it. Obviously, it's good in theory, but actually, I know a lot of people who've come also and said that, listen, I can take a lot of risk, and I don't mind some volatility, and I'm happy to be invested. But like you said, in a year's time, they don't see any returns. Then they get scared, or if they don't ever, they see the market going up and down too much, their blood pressure goes up. So that means that person is not that capable of taking risk, though they might think they are. So honestly, the theoretical part can work, but honestly, only once you invest in the markets will you actually realize. Only with experience, like in everything else in life, that experience only teaches us that how much good you are in taking your how good you are in taking how much risk. And secondly, I would think that it's important to I think this is one thing that I have been telling people, that it's important to learn about behavioral biases. I think that can help you a lot in these markets, or in market in general, just to know the behavior of yourself and of other people. So having certain behavioral biases that you can attach, that okay, this is going on. For example, let me just give you one example. So there's something called a representative bias. Okay, so a couple of weeks back, we had this Silicon Valley Bank, right? There were problems in that, and suddenly there was a problem in that, and all banks started going down. Now Silicon Valley is one bank, so what our mind does is we represent all other banks as a Silicon Valley bank, but those problems might not be available, might not be there in other banks, but all the banks go down. So if you know all these things, then you can say, okay, this is representative bias going on. I might get a good opportunity to buy at some point, because this doesn't make any rational sense, because this bank is actually doesn't have those problems. So representative bias is one. Again, availability bias or recency bias, like you extrapolate what's going on in the recent past to the future. So if markets are only going up during like COVID, then people will just think it'll go up forever, and once you know such biases, then you will be better off taking better financial and money decisions. So I urge people to learn about behavioral biases. I think that really helps in markets which are volatile, and it helps in your own behavior to make better decisions and to stay the course when it comes to investments.
Exactly. So now, since you mentioned asset allocation diversification, what about someone starting out with a debt investment? What kind of debt instrument would you recommend one should actually pick considering the changes in the LTCG and the indexation benefit which was there from 1st April, it won't be there on any of the debt mutual funds. Do you think starting out with the debt investment can be a better strategy, since you are not aware of equity markets, you are not aware of the risk, and within the category also, debt mutual funds should be the choice, or anything in fixed income?
Yeah, so again, in debt, there are a lot of products, okay? Like, so there's short term, medium term, long term, So again, I don't think people should really look at investments really from a tax angle as such. Yeah, its tax angle is important, but that should not be the starting point. The starting point should be your goals, what goals you have and how long they are for, instead of just the taxation part of it. Again, I feel yeah, there would be definitely some money moving out of probably debt funds and going to FD and stuff like that. But again, when I say that debt funds are still having some advantages, the advantage is that the debt funds, you pay taxes only when you redeem, so even after 4-5 years, if you redeem, you'll pay tax only that time. Whereas in FDs or some of those products, you'll pay on an annual basis, you'll pay taxes. Also, the advantage of debt funds is that you can remove some part of your money without any penalty or any of that stuff. So you can defer the tax and you can take out part payment of the debt fund. Obviously, the indexation benefit was a huge plus. That has gone, but I still think debt funds have a place to play, have a part to play in people's portfolio. Now, because of these debt, because of the indexation gone, I think you'll have three categories of funds. One is funds which have less than 35% of equity, less than 35% of equity, which will be counted as the debt fund, which will not have any benefits of indexation. Second would be funds which will have between 35 and 65% equity, which will be for which there will be indexation benefits. And the last thing will be above 65% equity, which we will have a equity fund portfolio, or equity fund taxation, sorry. So you might see some people moving out from the pure debt funds and going into the hybrid funds, as you call it, between 35 and 65% to save tax. But again, it will all depend on people's goal, where they would want to invest in. But sometimes the hybrid funds might make more sense going forward now.
Neil, last question to you. Any idea when will the international investment limit go up for your flexi cap fund? Any update there?
I wish I knew. So there's nothing that is come right now. So we had the restriction on international of remitting money overseas and buying international stock last February, and nothing so far has come out on that front in the sense of opening the limits. What the regulator has said, that if you had seen redemptions in your international fund, you can top up to the Feb 28th limit that was there, or what your fund was that time. So we have not seen any redemptions in our flexi cap fund, so we don't have any leeway to invest more money overseas. So I think, like me or everyone in the industry, is hoping that these limits open up and we can take advantage of overseas investing.
All right, Neil, thank you so much for being on the show today and helping our viewers with all the necessary steps that one needs to take if starting out with the investment journey. Thank you so much. On that note, we'll take a quick break, but post that, let's talk about insurance.